Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to talk about the most recent CPI report and the effect on the stock market. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out Into the Cryptoverse Premium at intothecryptoverse.com. One of the things we talked about yesterday was sort of discussing likely outcomes based on where CPI comes in. And of course, we never know exactly where CPI is going to come in, but we can sort of guess as to what the market would do based on if it comes in under expectations or over expectations. And you can see that core inflation came in at 6%, whereas consensus was 6.1, and headline inflation came in at 7.1%, whereas consensus was 7.3. And what we said yesterday was that if it comes in below expectations, the likely outcome for risk assets in general, stocks and crypto, would be to see a short-term move to the upside. Okay, so if we go take a look at the S&P 500, you can see right now it's sitting at 3990. One of the things that I want to draw your attention to is the hold above the bull market support band last week. Okay, so we held the bull market support band at around 39.30. This was something I talked a little bit about on the premium side, but we held at 39.30. And this week, we're still holding just above that level. However, we also have this macro downtrend line that we've been facing up against for a number of times, right? I mean, we've been rejected by it 4 times now. Now, let's go back in time and look at the dot-com crash, because we have followed this to a large extent. And actually, during the dot-com crash, we had several different tests of that trend line where we came somewhat close to it and just systematically got rejected time after time after time. But one particular interesting area to look at is what happened in December. Okay, you had a rejection off the trend line, and then we held support on the bull market support band. That rally lasted until basically the end of December, the first week of January. That's where that rally ended up lasting. Okay, so you had a rejection off the trend line, holding the 20-week, a pop above the trend line. We actually then came back down in February, and then we came back up for a double top in March, and then sort of back down in May. And then this, as the old saying goes, right, sell in May and go away. Of course, back then, this also would have been an accurate assessment, even though we had already come back down, because after May, you can see that the market from that level actually dropped, another 30% or so, especially if you take it from where it got rejected right here off the bull market support band, about another 30% drop or so. And so our general expectations yesterday of if it comes in below expectations, then what'll likely happen is we'll see risk assets rally in the short term, right? We'll see them rally in the short term. Furthermore, we would expect the interest rate hike tomorrow by the Federal Reserve. I'm expecting it to just be 50 basis points, right? I said yesterday, if CPI comes in below expectations, Powell has already said that there's a good chance that they'll lower it down to 50 basis points by December. And I think that's what they're going to do. I think tomorrow we'll see a 50 basis point rate hike. It'll bring the Fed funds rate up to 4.5%. And then I think there's a chance here that the markets will celebrate for a little while. Okay? Just like they did during the dot-com crash. They'll celebrate for a little while. The main problem that still is out there, right? And I know some people are tired of hearing the bearish side or the bearish bias, but I think the main issue that still exists is we still are unaware of how the interest rate hikes that the Federal Reserve did this past year, how they're going to affect the economy in 2023. And this is sort of the thing that continues to really stand over us and make us wonder, will we head into a recession in 2023, right? And if we go take a look really quick and take a look at, we have the yield curve. So we talked about that a little bit yesterday as well. But if we go take a look at the Treasury yield spreads, again, you can see the inversion of the 3-month and the 10-year yield, right? And normally there's only one way out of this mess, and that's via recession, okay? And we know, based on history, the stock market typically bottoms during the recession. During the dot-com crash, it actually bottomed after the recession. But usually we see an S&P 500 major bottom at some point during the recession. And so as we continue to follow the S&P 500, assuming we get some type of pop here above the trend line, that doesn't necessarily mean the bear market is over, although I'm sure a lot of people would hope that is what it would mean. And again, there's always a chance, right? There's always a chance. However, we still have to contend with earnings in 2023 likely coming in below expectations, and we also have to contend with a potential recession. And the recession would likely be declared once the unemployment rate goes up. And the way the unemployment rate would go up is all these companies starting to feel the effects of these interest rate hikes from 2022, but only starting to feel them in 2023. So then you could see something like, sort of like a playbook here would be the Fed raises 50 basis points in or tomorrow. Okay, so suppose they raise 50 basis points tomorrow, and then in February, it'll be interesting to see what markets are thinking. So February, the market is saying right now the most likely outcome is just 25 basis points, which is a possibility, right, to get us to 4.75%. In March, to get that to that 5% level. And then there's a chance they get to that 5% level and just hold. Okay, that's actually what markets are thinking right now. They get to 5% and hold, because that's the highest probability out of all of these outcomes. So looks like markets are thinking right now the Fed will get to 5% by March and then hold it there and wait. And then we wait to see if inflation actually comes down in a more sustained way. The issue remaining is what happens if if the Federal Reserve loosens policy too much and then it starts to go back up, or simply perhaps inflation does come back down, but one of the ways it comes back down is via recession, right? We know that recessions have a way of bringing it back down. In fact, if you go take a look at here at headline inflation year over year, what you'll notice is that one of the ways to bring it back down is via recessions. Okay, and so that is the way. I think there's two ways, right? I mean, you get out of this high inflation via the recession route, or you also could theoretically get out of it via the if interest rates are just held at a high enough level and somehow the U.S. economy is able to absorb it. It's not my base case by any stretch of the imagination, but I suppose that would be sort of the soft landing route. But anyways, right now the S&P is sitting just below the trend line. I believe futures are showing that they're up today. So depending on where we actually open, a good chance that the S&P is going to pop above this trend line. Again, it depends on where we actually are at the open. If we do pop above it, that doesn't mean the bear market's over, just like it didn't mean it was over back in the dot-com crash. And we still, again, and if you look at this, we still have the sort of this recession looming in the background that people have been talking about forever, right? But the unemployment rate still hasn't gone up yet. So if it hasn't gone up, recession is just simply not going to be declared. So that's what we're looking at right now. General expectations, of course, are that this initial pop by risk assets, I think was the most likely scenario if inflation came in below expectations. But I still think you have to be on the lookout here of this rally fading at some point within the next 2 to 3 weeks, and then we sort of wake up into 2023 and then figure out what's what and who's who as we sort of figure out whether we're going into a recession or not. Again, thank you guys for tuning in. Make sure you subscribe if you're not subscribed. Give the video a thumbs up, and I'll see you guys next time. Bye.